Hello, my name is Kurt Jackson. I'm a certified mortgage planner in Liberty, Missouri. I've got a little bit more than 17 years experience in the mortgage industry, and I wanted to welcome you to a series of videos which are designed to help you better understand the role of credit and credit scoring in your lives, and especially in the context of getting a mortgage loan, whether you're buying a home, wanting to buy a home, or you already have a mortgage and may need to refinance now or at some point in the future. Now, before we continue, let me give you our little disclaimer. We're not attorneys, and this is not to be construed as legal advice. The information given in this video series is designed to alert you to aspects of your credit bureau that you can consult with an attorney on. You know, credit's always been extremely important to you, the consumer. It's because banks, other lending institutions, insurance companies, potential employers, and the like have always leaned heavily on credit and in their decision-making process, and they especially like the credit scoring model because it gives them long-proven statistical data that they can base their decisions whether or not to lend to you on, or what insurance premiums you will pay, and if they will hire you or not, without coming under the fire for some sort of discrimination in their decisions. Credit scoring has been around since the 1950s. It's become more and more prevalent since the 1990s. And now, thanks to the current credit crisis that we're experiencing, your credit score will be even more important to you, especially in the mortgage arena. See, this credit crisis has created a more stringent risk-based pricing model that lenders are now following. Risk-based pricing means that if the lender deems you to be more risk, you'll get a higher rate than someone they deem to be less risky. That's if you qualify at all. It's always been kind of like this. It's just that the credit score levels were a lot lower before borrowing costs went up. And now the scores where the higher rates come in are much, much higher than they were even in 2007. In this video series, we'll attempt to explain what's happened to cause the credit crisis, what the impact of lower credit scores actually means to you, and then we'll explain the best that we can the credit scoring model and what types of things can impact your score. And lastly, we're going to share with you some strategies that you can use to improve your score, maintain your higher score, and give you the opportunity to work in an affordable way to get some professional legal help to clean up your credit and improve your credit score as quickly as possible if you deem that you need that. As we go through this information, feel free to pause, rewind, listen to it as many times as you like, and most importantly, take notes so you can email or maybe even call us with your questions. We'll be happy to answer any questions that you have. Let's start with what's happened to cause this credit crisis that we're currently facing. And we're going to borrow a great explanation heard from a gentleman by the name of Dan Green. He's got a mortgage blog it's located at www.themortgagereports.com. It's a great resource if you want to read some information about what's going on in the mortgage industry. First, you got to have a lot of people. First, we have a lot of people from all over the map of credit scores and the ability to prove income that would all like to own homes. Now, before 2002, the people that are in the middle of the picture, inside the circle, they were the only ones that could qualify for home loans. They had good credit, they had money to put down on houses, they could easily prove how much income they made, and they were buying houses that they could easily afford. There were even some in there that had some credit issues, but may have had more money or more equity in their homes, and they were still able to buy or own a home, and there were loans for them. Well, what happened was Wall Street, or at least investors on Wall Street, took notice of how well these investments, which were mortgages, were performing, which meant people were paying them on time. So they started to get a little greedy and wanted more of these loans. Well, they found that with the current underwriting guidelines, there weren't really any more people that they could help that fit those guidelines, so that would create that added demand. So in 2003, the folks on Wall Street started to let people buy homes with less money in the bank or less money down on their house, so the people in the next ring were able to now buy homes, and their loans were performing very well in 2004. So Wall Street got even more greedy. So that in 2004 they eased lending guidelines again, and by this time they let people with, their scores were a little lower, buy homes with no money down or little money down. So even more people were able to buy homes. So those in the next level bought those homes, and these loans performed pretty well. So Wall Street got even more greedy, and they said, we want more of this. So in 2005, the guidelines started taking people with not so good credit. They didn't have any money, and since they really didn't have the income to be able to afford the house, the lenders didn't prove their income. So what happened was people were not only lying about their income so they could buy a house, they even told bigger lies about their income and bought bigger homes they would never be able to afford. So they let the people in this outer ring that you see here buy homes. Well, in 2006, those loans in the outer ring where people bought houses they couldn't afford, they started to go delinquent on their house payments. So they stopped being attractive investments to Wall Street. So late 2006, early 2007, these programs started to go away. So this outer ring of people, even though they had gotten loans before, couldn't qualify for new loans, and many had adjustable rate mortgages that after 2 or 3 years were beginning to jump up by as much as 50% in payments. Well, that created more problems for more people, and since that outer ring of people could no longer buy houses, the demand for houses began to drop. So values in many areas, especially the ones that saw huge price jumps, like California, Florida, Arizona, Nevada, and really the mid to upper East Coast area. So these house values stagnated or began to fall. So those folks in the next ring who were really getting by because values went up, they couldn't keep refinancing to bail themselves out of the loans that they probably shouldn't have been in. So those loans began to go delinquent, and they no longer performed as well as they had been. So had performed as well as Wall Street had hoped. So Wall Street quit offering those types of loans to folks in that ring. Well, in 2007, Wall Street investors got really nervous and ended up pulling basically all the loan programs that had created the outer ring. So those folks that could own homes could no longer qualify for loans, and many have gotten into a jam and have had to sell their houses or lost them to foreclosure because the types of loans they had gotten when they bought their homes, they can no longer get loans. So what's happened is we went from where we were lending, where it was more traditional in 2002, right back to those lending guidelines now in 2008. Except now, if you don't have the absolute best credit scores, you're either not going to be able to buy or refinance your house. You'll likely need more money to put down or to have more equity, or you're going to have to pay a higher rate and cost, so it's going to be more expensive for you to own a home. Now, folks, don't let this scare you away. It just means that your credit score is even more important now than it's ever been for all your borrowing needs and many more aspects of your life that we've already kind of touched on. Now, thanks for watching the first in our series of videos on credit scoring. Make sure you tune into our next segment. If you got any questions or comments on this segment, please email us at kurt@kcmortgageplanning.com or call our office at 816-415-1737 or any of the numbers that are listed on the screen now. Thanks for tuning in.